Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Tuesday. It's April 26th. And as you can see here, it's about 7:47 in the morning. The market's going to get going in about an hour and, let's see here, an hour and 40 minutes or so, give or take. It's too early to do advanced mathematical calculations for me. Anyhow, as you can see here, the NASDAQ is down about 70 points. The Dow is down about 160 points, even though we closed down pretty good after starting the day on the downside yesterday. Now, I want to tell you guys something really important. When the markets start out lower and end up higher, that's a very bullish sign. When the markets start out a lot higher and go lower, that's a bearish sign. Typically in a bull market, you'll see stocks opening lower and edging higher as the day goes on. And in the bear market, you'll see stocks opening higher and moving down as the day goes on. Now, yesterday we did see that. We saw the market start out lower and go higher. And today the market's starting out lower. Don't know if it's going to head higher. But we do have earnings this week on the big FANG stocks. And I gave you a big preview yesterday. I made a video of talking about all of them. The Googles, the Facebook or Meta, let's see who else, Microsoft, all the companies that are going to be reporting, not Microsoft, there was another one, but all the Twitter, the Googles, the Amazons, all of those companies are reporting this week, the FANG stocks. And they're coming out starting today all the way into Thursday, maybe even Friday. And I'll do another video with an update on the numbers later today or tomorrow. But expect a lot of volatility while we're going through this period. Now, a few things for you. Put the call ratio, one of the best indicators, is still showing we're grossly overdone to the downside. Yesterday, we were at 130. And as I pointed out, that's the highest level we've seen. Look at this. That's the highest level we've seen right here since 2018. Let's see here. Nope. Since 2018, that's a higher level than we saw during COVID. This is COVID right here. We're above that level yesterday. So if this market is not oversold, I don't know what is. And remember, the put to call ratio is an inverse indicator. It's a fading indicator. If we're above 1, that means the market's set to go bullish. If we're below 70, the market is set to go bearish. Well, if you look at it over the last year, or the last, let's see here, the last quarter, not over the last year, even a little further, actually, if we go further, you'll see that most of the price action has been to the upside. We haven't had too many days, or we haven't had any days below the 70 level in quite some time. And that's telling me the market is oversold and needs to bounce back up. And again, typically I don't look at these numbers when they're in this range. This range means very, very little. But the fact that we're right now, and we're way above, and I mean, look at that. I'm not messing around. Look at this level, 130. When was the last time we were at this level? That's telling us the market wants to go higher. And we're still at 116. We're not out of the danger zone. 116 is around here, right? See, right there. So we're not exactly out of the danger zone, and the market has the capacity to move higher right now. Aside from that, we've got volatility. Volatility peaked the last few days, but I believe we're going to, as you can see here, most of these spikes are not that hard or heavy, and we tend to revert back down. So if the market turns positive today, there's a really strong sign, probably a 85 to 90% chance, if the market turns higher today, that this volatility level will go lower into the low 20s, and we can take profit on that nice juicy bonus position that I gave all of my discretionary students yesterday. Now, the bond market, as I said, it's still happening. Look, market's opening higher. Now the market's down 150 points, but look at the bond market overnight. It's positive. This is very, very, very important, because this is continuously telling us that the bond market may be a little overdone, and the bond market is telling the Fed we are already priced in whatever you've got planned for us. Because remember, Fed is saying higher interest rates, higher interest rates. When bonds go higher, that means lower interest rates. And look where the bond market started, at 155 all the way to 118. Enough is enough. So a nice little pullback is welcome at these levels, and I'm hoping, even if we don't go higher, if we go higher, I'm going to sell bonds, so we could take advantage of it again to the downside as the trend reverts lower. But the fact that bonds are not going lower is a very bullish sign for the stock market, because that relieves a lot of pressure on the consumer discretionary and tech stocks because they go lower with higher rates. People buy less tech and consumer discretionary when interest rates are higher. They charge less to their credit cards. It's just a common sense thing. And the fact that the bond market has 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 2 weeks now has been sideways is a very, very strong proposition that the long bond is saying, hey, Fed, we're done for now. We are done. You could be promising whatever you want, but we are done for now. That would be very, very stable, especially now when the Fed is talking about raising interest rates 0.5 basis points, 0.75 basis points, instead of their regular 0.25 basis point. So that's very, very significant in my opinion. The put-to-call ratio is very significant in my opinion, and the bond market, very significant. Now, volatility also, as I think I just mentioned that too. Now, let's talk about news today. We've got durable goods. They're coming out in about 37 minutes. Then we've got consumer confidence. Now, durable goods is a very important report. Let me see if I can give you some indications of where we stand on it. My computer's slow. So durable goods, we're looking at a 1% increase on new orders. I'm looking at it on a core capital goods. This is the most important part right here. I'm not big on the transports. So for the consensus is right here, 1% and then 0.5%. But the fact that we're all over the place on this range tells us that we just don't know where we're going. So this will be very good because it'll give us an idea of how new orders are being placed with domestic manufacturers for factory hard goods. Very, very important. I'm hoping that the number is solid. If the number is solid, it shows that the economy is ticking. Then we have consumer confidence ahead of the GDP. Very important report because consumers make up 2/3 of the economy. I'm hoping that the consumer confidence is strong. If the consumer confidence is not strong, it could turn the market down on a dime. And remember, we've got the Ukraine crisis. So it'll be very interesting to see how confident consumers are in the economy. If we can go above 106.8, look at this, 111. They're getting very overzealous. If we can get to 108, 109, that's a solid number. But those are the numbers we're looking at right now. Tomorrow, the big report is international trades in goods and services. That'll give us a good idea of how the supply and the supply chain and the inflationary pressure is impacting us on an international basis and give us some clues into how Chinese COVID outbreak is messing things up. And then we've got the GDP. This is the biggest report of the quarter. And I'm actually really curious how that report will do for the bond market. If it turns bonds higher, and it would only turn bonds higher if the numbers are better than expected. But if it turns bonds higher, then the Fed may say, because the economy is running really, really hot, then the Fed may say, hey, it's time to do further rate hikes. If the number is not hot, then they'll say, let's just do a quarter or maybe not do anything, and that'll cause bonds to even go higher. So it's maybe one of those situations where if the number's really good, it's bad for the economy, and if it's low, it's actually positive for the economy because then it would forestall the Fed taking action. Now, let's talk a little bit about the news, right? I mean, it's all about global economy and earnings. And remember, from today till Friday or Thursday or Friday, we have the FANG stocks reporting. So we're going to have a lot of volatility one way or another. Chinese shares skidded on renewed concerns over pandemic lockdown, just as we thought they were getting out of this. Oil prices declined. An overnight rally on Wall Street carried over into the world, but declined in Shanghai and Sydney, and now it's hit us here too. Suggests that the concern over Chinese economy are still persisting. And also remember, we're in earnings season. Beijing is enforcing mass testing and closing down access to some neighborhoods. The following lockdown in Shanghai and dozens of other cities cites that economists say might further crimp the world's second economy, hindering global economic growth. And that's a big, big problem that the Fed has to pay attention to right now. Because the last time that happened, they forestalled doing anything to interest rates. Expectations that the economy, a big consumer of all commodities, might slow down have hit prices of nickel, copper, aluminum, and zinc, which fell and hit us because we have a lot of exposure all over our portfolios. I honestly think that's an overreaction. I think commodities are going to go higher because there's going to be a bigger demand for them because of the war and everything we're seeing in Ukraine and because of COVID. But what do I know? The economy is rebounding from the travails of the pandemic as the government lifts COVID restrictions Case numbers have abated after a wave of the Omicron variant. That's around here, but not in China. On Monday, the S&P climbed a little bit, erasing early losses of 1.7%. This is what I was telling you, how if we start out low and then go higher, that's a bullish sign. Now, the rally was led by stocks of internet-related companies like Twitter, which jumped after we were hearing news that Elon Musk is going to be a CEO of another company. Will he ever stop? Wall Street is in the midst of one of those important stretches of earnings season. As I explained, we've got Apple, Microsoft, Amazon, and Google all on deck this week. And these are some of the biggest companies on Wall Street, and they're going to set the tune or give us some directional bias. And I think a lot of stocks turned off of the 200-day moving average or bounced off the 200-day moving average yesterday, which is a good move in the right direction. Worries are also high that the U.S. economy might slow sharply or even fail into a recession because of the big interest rate increases that the Fed is expected to push through. Let's just live another day. Let's see what happens after they report the GDP. Besides their bottom line profit numbers, investors are looking for a better sense of how big companies like technology, industrial, and retail are handling rising inflation and supply chains. Yeah, this is going to be very important because the Fed will have to make some important decisions. The Fed has already raised its key overnight rate once, the first such increase since 2018, which is one of the reasons why volatility is higher. The chair of the Fed has indicated that the central banks may hike short-term rates by double the usual amount. But again, what does the bond market do? It goes sideways. When they're threatening and not doing anything, it's going down. But when they actually start doing something, it turns. Buy the rumor or sell the rumor, buy the fact kind of a thing. But again, the fact that bonds are moving higher is positive. Put the call ratio being way stretched out is positive. And if we're looking at stocks, we haven't really changed our tune. April 25th, consumer staples still leads. Communication services lags. Now remember, once we organized this, that was monthly. When we organized this, energy still leading. Communication services is still lagging. Nothing changed in 3 months. Look at this, 1 month. Energy, communication. That's March 23rd. Let's go back another month. February 18th, energy, communication services. Let's go back another month. Energy, communication services. That's 3 months. No change. That's why I use this thing. Now, top stock. Let's talk about top stock. Top stock in the energy sector right now would be Occidental Petroleum. Or you can go with Apache, either Occidental Petroleum or Apache. All of this is basic materials and resale. And I told you guys this would happen a few weeks ago. Remember I said that energy is going to start declining and Mosaic, Nucor, CF Industries is going to, it's happening just as I predicted. You still have a lot of energies in here, but it's getting slightly mixed up with consumer staples and basic materials. So definitely Occidental Petroleum or Apache. You can't go wrong with either of them. And on the worst stocks, Netflix and PayPal, both communication or tech, Etsy, PayPal, Netflix, and Meta. Take your pick. Here, you got all four, and they're all crap, and they're all in the communication services sector, including Netflix and PayPal and Etsy and Meta. If I had to put a negative connotation on something right now, it would be Etsy and Netflix, because we know Netflix numbers have been really, really, really bad. Now, tomorrow, oh boy, tomorrow I'm going to give you an actionable trade idea to the long side and to the short side. But before we do, listen and listen good. Volatility is nuts right now, but Chuck Hughes, multi-million-dollar trading champion, he has been secretly working on a project that could be the cure for the current markets. He says it's the boldest prediction of his entire career. So Chuck and I will go live at 1 p.m. Eastern Time today to host his big reveal. Now, while the rest of the world is in chaos, scratching their heads, wondering if or when the recession will come, he's gearing up for takeoff. And by following the facts, not emotions, he believes we could be set for a windfall of a decade. Windfall of the decade. You guys want to pay attention. This is big. Click the link below and learn more about Takeoff and to access today's live event. I'll be there. You don't want to miss out. I'm gearing up for this. This is going to be red hot. It's happening today at 1 p.m. Eastern Time. I do not want you guys to miss out. I'll be there. I'll give you a full market update. Be there or be square. 1 p.m. Eastern Time with Chuck and I live from the Ponte Vedra office. Tomorrow, one long, one short, actionable trade idea, complete with all the accoutrements. Follow the link below. If you can't find this, follow the link in the Wealth Press YouTube channel. I hope you guys have a wonderful day. Send me some love letters. T-Buzz gets love letters. I want to get them too. Support at marketgeeks.com. Bye, guys. Have a great, great day.